Welcome, everybody. Welcome to our first financial model teardown. The word teardown is kind of scary, but it's actually meant to be very inclusive and educational. And I am very, very excited to be joined by the Forecastr team, who I've been working with for a long time, and three new founders that I met today. We will have 4 models to go through, but we're only able to get 3 founders just through scheduling. But I think we've got companies from every weird industry that you could imagine, so it should be really educational and cool. I will kind of MC this event, but Stephen and Logan are going to do most of the feedback and talking. We're going to try to make it a little interactive too. Hopefully everybody learns something along the way, even if your model's not here up on stage. And I will introduce each of the founders. This is the first time we're doing this, so might be some rough edges, but I think it's going to be cool. It's going to be casual. You know, we're coming into the holiday. We're not here to do stuffy presentations. Despite Stephen wearing a 3-piece suit at the moment, we're pretty relaxed. Logan is trying to be relaxed. I'm wearing a t-shirt. But this should be great. So we'll kick it off. Stephen, Logan, if you just guys introduce yourself and your company really briefly so they kind of know where you're coming from and that they will actually believe anything you say.
Big time. Well, here, Stephen's dressed nicer than me, so I'll let him go first.
Right on. Thanks, Ryan. Hey guys, I'm Stephen Plappert, co-founder and CEO of Forecastr. We're an online financial model for your startup. So it's an alternative to Microsoft Excel when it comes to building to managing a model, and we like to think it's a lot better. So that's what we're checking out. But Logan and I have been running the company for about 3 years, and I'm a serial entrepreneur. So I've been an entrepreneur for 10 years now. I had a consumer company that I ran for 3 years, 2013 to 2016. I failed that company, and then I spent 4 years as a fractional head of finance for early stage startups, largely between seed and Series B, outside of a 6-month hiatus hiking the Appalachian Trail. And then I've been honored to be building Forecastr alongside Logan for the last 3 years. We've got a little bit over 500 startups using Forecastr now as an online financial model. We do about 1.3 million in ARR. So we're gearing up for a Series A early next year. So a little bit about me.
And about me, so Stephen stole a lot of my thunder because our background when it comes to Forecastr is the same, because I'm also a co-founder of Forecastr. I'm the COO, so I'll plus one to everything that Stephen said, Forecastr related, but then I will also just note that I'm the resident finance nerd here. So I got a finance MBA. I invested the Kentucky Pension Fund for a good portion of my career, and I was a fractional CFO for a number of years as well. So I know my way around a good financial model, and I'm looking forward to tearing some down today. Just kidding. It's not going to be that stressful, but I look forward to looking at some today.
Awesome. And I'm Ryan. If you've been to any of our events in the past, Ryan Nash, I'm the CEO of Gust. We provide tools for early stage startups, angel investors, and accelerators, and we try to connect them. And if you've been in any of this programming recently, we spent the last 6 weeks running what we call kind of a founder series, a prepare curriculum. We're trying to people at the idea stage, get them everything they need to know to really jump into a startup. We're going to continue that programming into the actual launching and scaling and growing of company into the new year. So be on the lookout for stuff like that. But this event came out of, the huge engagement and attendance we had at some of these events, specifically with Forecastr. And that was really just financial modeling 101. But people asked such cool and specific questions like, how does this work for a hardware startup? How does this work for a startup with a lot of, capital requirements up front? How does this work for a consumer product startup? The principles are there for any business model, like financial modeling and forecasting. The principles don't really change. It's just how you adapt it to your specific situation that does. So going from the abstract and the principle-based stuff to just a real analysis with our community, with founders that have been, using our tools, I think is going to be really, really fun. And hopefully we'll do more of these. So if you were late to submitting to any of this, I know we got a lot of people submitting. But be on the lookout. We'll do more programming in the future, and you'll see the Forecastr guys again too. All right. Oh, and if anybody needs to ask, we will record this. We will distribute it. It might take me a week because I am getting slightly into holiday mode, but it will come out and we'll have links to all sorts of things. And I'm pretty sure the Forecastr team will pass on a cheery and merry discount for anybody who's hanging out with us.
Oh, yeah.
All right. Without further ado, I think we can get into it. We're going to go Dana, Amy, and Femi. Femi, am I saying your name right? Cool. So the way we'll do 90 seconds for the founders to introduce their startup, the elevator pitch. We're going to ask the audience what they think of not just the pitch, but the model. So we'll have the model up before we do the voting, and then we'll get in and we'll make this collaborative, back and forth between Steve and Logan. I will MC any questions. I opened up the chat. So if anybody wants to chat, tell us where you come from. If you have your own startup, what it is, throw it in there. Just don't spam and don't pitch. And we will answer any questions. If things pop up and we get feedback, we can pull stuff up or use the Q&A or anything like that. All right, we're ready to go?
Ready to go.
All right, Dana, take it away.
Ryan, I have a quick question. Both my COO and my CEO are trying to click the links that you sent them, and neither one is able to get connected.
Oh, that's interesting. Are they in the Zoom at all, or are they just participants, or do they want to get up on the panel?
They don't want to get on the. No, they're not. They're just participants. They want to listen to the critique so that we can meet later and collaborate on the feedback that we get from your team.
Perfect.
You'll find Dirk Bellamy and Justin Kruger are the two.
Yeah,
guys.
I got them on an email thread. I will invite them right now.
Thank you very much. All right. Hello, I'm Dana Lee, founder and chairman of 21st Century Fuel. We want to build a large green ammonia fertilizer plant here in the Pacific Northwest and distribute it to commercial ag customers in our region. The lead time for a project like this is about 5 years, which puts us in the position of needing funding to get from where we are for our small team to cross all the T's and dot all the I's to the point where we have put the downstroke on the deposit for the large fertilizer plant and kick off the engineering design and construction process. We have secured assurances that the power price that we need to make this model work is well within our acceptable range. And we have had preliminary conversations with offtake buyers of our green ammonia fertilizer and find that that's a concept that they are interested in. Currently, all the ammonia fertilizer in the world is or almost all of it is produced using natural gas as the feedstock. Ammonia fertilizer comes from hydrogen and nitrogen, by the way, and nitrogen is what the plant wants. So around the world, we have natural gas feedstocks creating ammonia fertilizer with enormously large footprints. Sorry, my dog is in the background and he is seeing some activity out there, and I can't mute him without muting me. The approach to green is an old one and a new one. Back in the 1900s, Norway was producing green ammonia fertilizer from electrolysis. We're going to mimic that process and do it using renewable energy that we source here in the Pacific Northwest. That allows us to say we've got green ammonia fertilizer going on the ground and allows every commercial ag user to reduce their carbon footprint by using our product.
Great. That's awesome. Thanks so much, Dana. So what I'm going to do now is I'm going to take the reins and I'm going to show the financial model that was submitted as a part of the Gust application so we can all see it together. And then I'll try to give as little context as possible, just kind of like go through it. And then we're all going to rate it. And then Stephen and I are going to give our ratings as well. So Ryan, can you see my screen? Give me a thumbs up if you see that. Okay, cool. So this was the financial model that was submitted. So you see we've got revenue, operating expenses, EBITDA, all of this good stuff right here. So this is the first page that we see whenever we jump on it. Then we have the second page, which is going to show you cumulative cash, some data there. They've got the liabilities, they've got the equities, so some of the balance sheet stuff. And then over here, we've got the net income and then just some other data. So it's really just kind of like a 3-sheet PDF with some data on here. So Stephen and I are going to get into our feedback on this, but before we do, this is meant to be a gut reaction. You see a model like this, what do you rate it on a kind of like a A, B, C, D, F, scale? So kind of like a letter grade. So Ryan's going to do a poll right here. So we're going to take a look at it. And then we're going to get into some of our feedback.
Polls up. All right. Sorry, I was trying to
Now
get emails going in the background.
I'll keep sharing so everybody can kind of see what the consensus is here.
Yeah, I will end the poll in a bit. Once we get to about at least, oh wow, we're already up to 60 people answering.
Yeah.
So once we get around 70% or so, I will share the results. Oh, this is fascinating.
Yeah, this is great. Oh, I guess they can't. You can't see it. Okay, no, I'm looking at it. I didn't realize that they.
Sorry, we're being jerks. All right, I think I will share it now.
Okay, go ahead and share it Okay, so yep, we can see that. All right, so the consensus was that this is a C model, right? So this is kind of like a standard, kind of like C. We got a, some people
Even
say A, B.
distribution.
Very even distribution, very even distribution.
It's almost like a bell curve.
Almost like a bell curve. Yes. Okay. Well, that's great. So I'm going to start with maybe my feedback, and then Stephen, I'm sure that you'll have a lot of the same.
Yeah.
Okay. So my initial feedback on this model is that it's not a financial model. So this is what we would show is like a set of projections. This is the output of a financial model, right? So I can see things like revenue. I can see things like operating expenses. What I don't know, though, is how you arrived at these numbers. I have no idea what these numbers are. They look like very lofty numbers. They look like it's a very big opportunity business, but I really don't get any understanding of the mechanics of how the business is going to be working, what your revenue formula looks like, all of the good stuff, the underlying engine that goes into producing these numbers. That's really what I'm looking for whenever I ask for a financial model. So ideally, this wouldn't be a PDF output type of sheet. This would be either a Forecastr account, like a model like that, where I can see kind of what's driving it, or it would be some sort of an Excel spreadsheet or a Google sheet or something like that. But as it stands, this is just some output that doesn't really give me a lot of good contextual information for the business. And I'll kick it to you to see if you have anything else to add.
Yeah, no, I think that's a great assessment. Like you said, it's a set of financial projections that we're looking at here. It's the output of the model, and what we would want to see in a financial model is just like Logan said, good like mechanics, represented in the model, and that's really for two reasons. One is, when you're telling your story to investors, right? When you're using a financial model to raise capital, you have to remember that you're telling a story. You're telling a numerical narrative, not just of the size of the opportunity, which these projections clearly show, but how the business works and how you're going to get from point A to point B, from the current state to the future state. So you want to tell that story of how you're acquiring customers. What is your customer segment? What do those contracts look like? At what price points? How are you generating revenue? And then, what are some of the key cost centers, like your hiring plan? Who you're going to need and when? In a business like this, I'm sure there'd be a lot of capital expenditure and things like that. So detailed looks into what those expenses look like and the timelines. So you really want to kind of tell that story to investors, but more importantly than that, you want an operational model that you can use to manage the financial health of the company. And so we really like to see, a monthly model, a model that is showing data on a month-to-month basis that then rolls up into these annual views, so that you have enough visibility and kind of resolution, month to month, to use the model to manage cash flow and make sure that you're in good shape there. And then you can do that kind of zoom out, for investors.
Yeah, that's exactly right. And I'll note here, and then we'll give you a chance to kind of respond, Dana. So everybody on the call, like every model that was submitted, we put together kind of like a report card type of thing for it. And then we also started building their financial model in Forecastr, just to give them a sense of the direction that we would take in. To give our grade on this one, it would unfortunately, I think, be an incomplete. So it'd be like an I, just because there's no real model to grade. It's just kind of the output. So what led to this output could be really great, but we don't know that because we don't actually have the data to understand that. So that's why we wanted to start with this one, just to kind of spread the cautionary tale that just a PDF without any underlying assumptions or underlying metrics that build up to it is really, it lacks the context that become useful for investors and founders. So.
And Dana, I believe you actually worked with an institution in putting this together. Can you tell us a little bit about that?
This was not an institutional model, Ryan. This was a model that was developed initially by one of the founders of the Clean Air Task Force in Chicago in 2010 or 2011. That was designed to present the economics of a natural gas fired ammonia plant and to look at how one might do that. And we took that model and asked for some help to repurpose it for an electrolysis model so we could make green hydrogen. And we have all of the things that you just said are lacking in this PDF. So my apologies for not understanding what you were actually looking for, but I'm looking ahead to becoming a forecaster registrant, and I'll show you all the details because they're certainly there. This is a very, very high level look at the business opportunity. And because it's such a long range opportunity, it's going to take us 4 years to develop. We actually have about a 15 or 20 year plan that shows the steady state model once we get into operation.
Yeah, and that makes a lot of sense. Honestly, when you started telling us about the business and we looked into it and everything, I had the sense that you probably did have a financial model somewhere that was powering this data, and it wasn't just kind of, spec'd out. So that's great to hear that you guys do have that robust model that's spitting out these projections, because that'll be really valuable, especially in a business that's as complex from a capital expenditure perspective as a business like you're starting. I think managing really the kind of financial aspect of this business it'll be a challenge, and so it'll be a business that it'll be critical to have a great model. So yeah.
But thank you, Dana. That was
great. Thank you.
Yeah, it's very, very helpful, and appreciate you playing ball with us and helping us out.
And one thing, I'm going to make a promise on behalf of Forecastr. Hopefully they'll hold this up. But if you can send over that stuff, I think we can get you the report card and the setup that we did for the other founders, even though we don't have it live, but that way you get the value out of that. And I will say, can you guys do that? I see you nodding.
Absolutely. Yeah. We'll 100% do that. So.
And I'm going to use this as an example of kind of the intersection between Forecastr and Gust. Can you guys see my screen for a minute?
Yes, sir.
So the kind of level that Dana provided is, and we talk about this in some of the events, there's many different lenses on your business model and your financial forecasts at varying degrees of specificity or granularity. In Gust, if you're building a Gust profile, you're going to be applying to angel groups. And I think what Steven and Logan said is when they first see that, they see the numbers and the size of the numbers, and it says, oh, this is a big opportunity, but the narrative isn't there. I'll blow this up a little bit. So when you're building your Gust profile, sorry, this is just a test account, so there's not a lot into it. There is a private tab called financials, and this is standardized stuff that all angel investors want to see. And you'll see at the bottom, they have that high level financials. This is not a financial model, but this is a signal to the kinds of investors you're pitching, right? There's some investors who are literally they're looking for short-term time horizons. They only invest in companies that already have traction, and they're looking for 30x returns. They're looking for 60x returns. They're unicorn hunters from Silicon Valley, and they only want a business that can basically achieve market dominance and huge returns. There's investors in Ohio and New York and the different, the non-coastal investors who are maybe looking for a 5 to 7 year time horizon, and they want a company that's going to get acquired or have an exit or something like that. So usually when you apply to an investor group on Gust or share your profile, the investors will get this kind of view of the company, and they'll see, does this fit in with my investment thesis? Are these numbers, is there enough zeros at the end of this? Oh, okay, cool. So the next step is I actually want your financial model, which is the more detailed narrative spreadsheets backing up, kind of what it is. But the two things should exist for pretty much any business. It's just the level of granularity depends on what stage you are in with a relationship or talking to a potential investor.
Yeah, big time.
I'm learning to show off our products more often. This is my 2023 goal, is to actually sell my own stuff more directly rather than just engaging with people.
As it should be, Ryan. Well, thanks, Dana. Do we want to move on to Amy?
Yeah, sure. Yeah. Hi, everyone. I'm Amy Schreier, founder of Catalyst Planet. Catalyst Planet is an online platform for world citizens. We publish and produce articles, videos, podcasts, and courses about international travel and global social issues. We really seek to reach a generation of people, primarily Generation Z and millennials, who perceive themselves as part of the world. We have a site up at catalystplanet.com. That's a basic early stage grassroots site. You can take a look at it. I founded this company because of my passion for the subject matter. I am a world traveler. I've been to about 40 countries. I've done some international work in Asia and Africa. And that is my motivation to grow it. We are seeking pre-seed funding right now. The model we're going to look at is actually our seed funding model over the next 3 years. Our primary revenues are advertising sponsorship, membership fees for premium content, and some affiliate sales. We are also seeking investors, advisors, and core team members to build out our team. So if you're interested, just reach out. Thanks.
Thanks so much, Amy. I appreciate that. And now I'm going to share my screen and we're going to take a look at the financial model here. So this is the Catalyst business model. Okay, so you can see now we are in Excel. We've got multiple tabs. So we've got a tab that's showing the profit and loss statement. We can look at how they're getting different types of revenue. So this is their advertising revenue. We have a bunch of rows and metrics here. We can see how they're getting their membership revenue, how they're getting their sponsorship revenue. So everything's broken out like that, as well as their affiliate revenue. We can get a sense of how they're going to be growing. So we can understand how they're growing their user base and where they're spending money on. And here's their traffic growth right here. And then they have a tab for assumptions to kind of explain everything and walk through the logic of how they're ultimately getting these projections. So this is the Catalyst model. We'll do the same thing. Ryan, if you want to put a poll up and just give your rating on how you would rate this model, and we can chat about that and then show our thoughts as well. We can see them coming in here. Right. Yeah, great engagement. I'd say I forget that you guys can't see it sometimes.
I feel like we've already educated the audience because this is far less of a bell curve than the first one.
I know. Okay, great. Well, we've got a decent number of respondents. Do you want to? Yeah, you want to call it?
There we go.
Okay, and you guys can see it. Okay, there we go. A lot of A's and B's in this one, which is great. And I think that we generally agree. So what I'm going to do now is I'm going to stop sharing really quick. And I'm going to pull up the report card that we created for this one. So give me just a second to pull this up. Oh, well, that's not good. Hold on, it said that I couldn't open it for a second. Just give me 1 second. It's going to be this guy, Catalyst. Pull this up. Okay. So now I'm going to share my screen. There we go. So Stephen, you want to walk us through this report card since you put this one together?
Yeah, you want to try and make it maybe a little bit bigger?
Yeah, let's see if I can.
So we gave this model a B-. So what we loved about this model, as you can see in the top section there on the revenue formula, is Amy did a great job of like really kind of detailing out the mechanics of the model. So going through like the traffic growth tab, to start with, that was great, where you really want to start at that highest level and say, hey, okay, how am I generating awareness for the company? And we did a great job of that in the model, describing the customer acquisition on a channel by channel basis, and then had separate tabs, separate sections of the model detailing out how each revenue stream works. So how are we generating advertising revenue? How are we generating membership revenue? How are we generating sponsorship revenue? That kind of stuff. That was really, really good. And they had good inputs and everything there. So that's exactly what we want to see in a model. And it was a monthly model, which is great as well. As far as the fundamentals, probably the weakest part of the model was that it was just an income statement model. It just only had that profit and loss. And so it had good representation of the revenue and how that's generated, and then good representation of the expenses as well. But didn't have the balance sheet. It didn't have the cash flow statement in there. And so that is a little bit of a weak point. We really like to see a 3-statement model because cash is king. Managing your runway is really important, and it's very difficult to get an accurate cash flow statement without the balance sheet. So you want to have those other 2 financial statements represented as well. But we did have a monthly model. We had an annual view. Those are really good. And then lastly, on this kind of design and user experience, and this is something that Logan and I really think is important, that, you know, when you're building a model, you want it to really look kind of clean and professional. You want it to be easy for investors to dive into and digest, because you want them to be able to use all of their kind of cognitive energy on the information in the model and not have to kind of reorient themselves as they're going through and kind of understand how things are laid out. And I think it was a pretty decent job, you know, from a formatting perspective as you go through the model. But each tab looked a little bit different. Some tabs, you know, had fixed panes and others didn't. And so it was a little bit clunky kind of going through the model and understanding where everything was. And so I think there could just be some polish that goes on from a design user experience perspective, and then rounding out the balance sheet and the cash flow statement. If you did those two things, I think this would definitely be an A model.
Yeah. And I'll double click on, you know, I think that this was a really, really great model, Amy. And so we actually took the liberty of putting something together in Forecastr to show a little bit more directionally where we would go with this. And one thing that you'll notice is that we kept a lot of what you had in the financial model the exact same. So you had Facebook boost, you had a budget for how much it would cost per month, and then generating additional traffic, and then having that all roll up. I took the liberty of putting influencers in there, and then some word of mouth stuff as well, just so you could get a sense of like the different ways that you could potentially grow. And then I mapped all of this back to your all's revenue formula, so you can get a sense of what your web traffic is going to look like, what your paid advertising is going to look like, so how much revenue you're going to get from that, subscriptions, affiliates, things like that. So I kept a lot of that the same. This is just maybe a slightly better looking version of the logic that you already had in your Excel sheet. So kudos on that. And then obviously we've got the people expenses, all of that stuff. But the biggest thing that Stephen was mentioning, just to show you what a success looks like, is you've got the income statement. What we're really missing are these two statements, the balance sheet and the statement of cash flows. And this is the stuff that investors are really going to want to see. And the reason it's so important is I can put in the amount that you're looking to raise right here, you know, this 250,000, and the investors, these numbers are wrong, by the way, this is just directionally kind of like explaining, but investors are going to want to see how much runway that's going to buy you. So like in these wrong numbers, right, this would say that you've got runway to June, okay, and you know, you'd want to true that up and make sure that the narrative kind of like matches what your plans are. But getting a granular look at cash and just understanding at a very, very granular level what the cash flow impact is going to be and what their investment is buying, and then how that's going to translate into this revenue trajectory that everyone's hoping to achieve, that's super, super important. So we'll share the report card. We'll share a link to the model that we started putting together for you, just to dig in so that you can get a sense of kind of the direction that we would recommend. But I would say overall, we think that this is better than the majority of models that we see. So really good job on that.
Thank you.
No problem. No problem. Okay.
Any questions or anything, Amy? I know Amy and I were talking like immediately after I sent out the invites. She's like, what chance do I think I will be accepted? And I wanted to say like almost guaranteed, but I wanted to wait until we got the rest of the submissions in. So thank you very much, Amy, for that and your patience with my emailing.
Yeah, no, thanks. That was very helpful. And yeah, we definitely need that. This is my second company. So in my first company, we always had that. I guess we feel like we're so early stage. We're dealing with pre-seed right now in terms of the funding raised. So this is really more of a long-term view, which is why we didn't get into that detail, but we definitely will.
Awesome. We have a relevant question from Nafis. I know you gave Amy good points for the monthly. So Nafis asks, when building a model, first year, can it be built on monthly basis? In the next few years, is it okay to project annually?
I think that that's passable for sure. Most people are going to be, I mean, like we recommend just doing the entire model monthly, just because it's a, better hygienic practice. People think of finance in terms of monthly, and it's good to just have monthly targets kind of in your head. It also really helps to just gut check in the out years, the output of the model to see, am I getting 1 million customers a month? Or, it helps you just kind of gut check that. But generally, the closer it is, like the first like 12 to 24 months are the most important. So if you are gonna, if you are gonna do that and you are gonna sum up to annual, then do it a few years out, but we recommend always just doing monthly.
Yeah, and just to double tap on that, like the important aspect here is really, it's less the kind of the time period, although monthly happens to be the best for this, but it's that the model is driven by the underlying mechanics of the business and not any kind of like high level year-over-year growth rates or things like that are really more what we would call derivatives. They would be metrics that should fall out of the model, not be input into the model as assumptions. And so the risk that you run if you make a monthly model that then turns annual is when you turn it to annual, you're largely just going to be looking at that first year and applying some kind of a year-over-year growth to assume what those year 2 and year 3 is. And so it's going to divorce from the underlying mechanics of the business. The reason Amy's model was so good is because she took into account how customers are acquired on a channel by channel basis, how revenue is generated, from these different channels. And if you've done that for 12 months, doing that for 5 years is just as simple, in an Excel spreadsheet, it's just dragging it out, and Forecastr, that just happens automatically for you. But it really should be the same formulas, the same kind of mechanics that should just kind of flow forward. And then your job as a founder is then to look at the output that's coming from that monthly model, assess if that ramp, that curve looks reasonable but attractive to you, attractive enough for investors, but reasonable enough to plan your cash flow. And if it does, great. And if it doesn't, you want to tweak it. And that's where this kind of iterative process comes in. And so, you really want to, build that first kind of 24 months, like Logan said, monthly. And if you've done that, it's just as easy to have 60 months, just kind of drag it out. So that's what we would recommend, just so that you do have that kind of basis in reality, if that makes sense.
Yep.
And the last thing I'd say on there is there's certain kinds of expenses that if you try to just do them yearly, you get yourself into very confusing territory. Hiring is one of the biggest ones. If you have runway and you're like, oh, we're going to hire a developer a month, it's like a developer a month is tens of thousands of dollars, adding to your thing. So if you view it yearly, it's like all of a sudden, kerchunk. But in reality, a lot of times the strategic way to hire is to grow as your revenues are growing or as your fundraising activities grow. And that does happen more month to month. And it's much easier to just, look at years built on months rather than creating months out of years, whatever. I'm not saying things.
Yeah.
Anyway, we got a couple of cool questions in the Q&A, but I'm going to save them to the end just so that we get everybody's time up here on stage and respect the calendar.
Yep.
You guys ready to go into Femi's model?
Let's do it.
Hi, everyone. Thank you. It's always a pleasure to be with you here with Gust and Forecastr team. Good evening from Paris. It's 8 p.m. and I'm Femi, co-founder of Dreamsbox. And my company is building the smart kids bedroom ecosystem. It started by an obvious question. If I ask my kids to choose between just listening to an audio story or reading a book or watching his favorite, cartoon, the answer is obvious. So, studies show that two-thirds of the leisure time of our kids is spending in front of screen, and nobody is actually dealing with this issue. The good news is, as parents, we want to deliver a better alternative to screen to at least 65 million families in Europe, and to break the status quo of just audio players and average complex, boring projectors. Bobby Listad is a digital edutaining content associated with a blue light-free projector, interacting with figurines to just give the kids, a limited fun. And the idea was very promising since the beginning. We have hundreds of early adopters around the world. We have two major content creators here in France wanting to collaborate with us. And we had even Philips that knocked our door to discuss to this matter. We are seeking a pre-seed round of about 500,000 euros. and we'll be glad to discuss any question and answer any question. Yeah, thank you.
Awesome. Thank you, Femi. All right, so I'm going to
Pleasure.
share my screen here, and we're going to walk through very quickly the model that was submitted here. So you can see that we have the three statements. So we have the income statement, the balance sheet, and the statement of cash flows. We have sales that are up here. We've got this typed in on a quarterly basis. And then you can kind of see broken down by business line what we hope to achieve. Moving to the balance sheet, we've got all of this spelled out here as well. So we've got cash and all of that. We have the statement of cash flows here as well. So the big three statements are here. And then we have a nice KPI section that kind of spells all of this out, brings it together. So with that, Ryan, do you want to go ahead and put together a poll to see what the consensus grade on this financial model is?
Yep. Here we go.
All right.
Also, when Femi said that 2/3 of child's leisure time are spent in front of a screen, like 2/3 of my adult work time is spent in front of a screen. Is that what the flip is now?
Yeah. Does make sense. All right, we got some coming in here.
I'm glad to see each of these are changing based on I think what people are learning.
I know. Yeah, it is interesting, isn't it? Okay.
All right, once we get to
consensus, you want to end it, Ryan?
yeah. Here we go. I will share this.
There we go. Okay, so it looks like we're getting that distribution back a little bit, and everybody seems to have gotten around a B rating. So I'm going to, hopefully I can just right here. And yeah, okay, that's not working. Give me
just leave it in the model this time, because they saw the report.
Okay, sure.
Last time. We can send that to Femi. I think it's more useful to look
that
at the
works.
model.
All right. Well, do you want to go ahead and start with your feedback then, Stephen, before I get into mine?
Yeah, totally. So thanks for submitting this, Femi, and it was nice kind of looking through this. A couple things from me. The biggest thing was the net sales, kind of at the starting point at the top of this model. Like we'd love to kind of dig in deeper and get more visibility into what's driving those sales. What channels are the products being sold through? What price points? How are these sales being generated, rather than them being just kind of hard coded in here on a quarterly basis. You may have that information somewhere, but that's really kind of the heart of a good financial model, I think, is that revenue formula, like we go through. So that's where we're going to dock the most points, is just not really getting a chance to see the underlying mechanics of customer acquisition and monetization, and only just getting to see kind of the output of that, which is the net sales like you've listed here. Now, it is nice that you have the number of sales on a product basis in a couple of different markets, the French market and the international market. So that's kind of a start after what we're looking for. But then you'd ask the same question, where's that 1,000 coming from in line 21, or that 1,500, et cetera? Like, where are you getting these sales numbers? What channels? What conversion rates? Over what time period, et cetera? So that's kind of the biggest area where we're gonna dock this model, I think. But we do have all three financial statements represented, which is good. But we don't have an annual view, and we have the quarterly view, which is better than annual for sure. But we really like to see that monthly view.
Yep, big time. And I agree with
right. Just to clarify things, this actual financial model was brought by a company that we partnered with. It's called Wedge Invest. Actually, this Wedge Invest company is a little bit investor focused financials. So with this said, their software we used, it's actually only prepared to just for investors, not to founders. I know how Forecastr software worked, and it's very good. It's better than this one, So that's why here there's no kind of where these sales are from, or maybe the hiring process. It was just made to look better for investors only. That's it.
Well, that's helpful context. I will say, I don't know if it changes our beat, or at least my feedback, too much, just because even from an investor standpoint, it's important to understand the underlying mechanics, the unit economics, the drivers of the business, just so that I could have a holistic understanding before investing, kind of what I'm getting into, and understanding the business strategy, which is perhaps a good segue into kind of our approach whenever we look at this. If I move this out of the way just really quickly. So we took a lot of the underlying information that was in your financial model, and then we kind of expanded on it. So some of the data that I have in here wasn't inherent in your financial model, so I had to take a guess at how you all might potentially grow. So I've got things mapped out like influencers. Like, if I have this many influencers posting at this many times per month, getting this many leads, how is that going to work, right? Like, how can I essentially grow if I'm using influencers as one of my mechanisms for growth, as well as paid advertising? So if I'm spending X amount on paid ads, what can my cost per click be? What can my conversion rate be? All of that stuff, just to theorize how I might grow, and then get a deeper understanding of, if I'm going to achieve these types of numbers, these are the targets that I need to hit. And once I know that, I can understand the resources that I need to budget for in order to hit these targets. And the other good thing about doing it this way is that I can, once I have this data, put together some unit economic analysis as well to understand, what is my CAC now that I've understood like my cost to acquire a customer. What does that look like? What does my revenue per customer look like? What do my gross margins look like? What does my CAC to LTV look like? All of that stuff that's so important for investors and founders, really both. All of that comes out of a nice bottoms up financial model. And you can see we've like put together total number of orders based off the price points that you've given. We've broken them out, by each of the individual products and things like that. We've input a section of, for people and other expenses. And then again, we can understand kind of the trajectory of the business within the 3 financial statements as well. You have the income statement, balance sheet, statement of cash flows in your model. And in this case, we can see, if we, again, these numbers are wrong, but if you raise $500,000, you can get a sense of what that runway looks like. And in this case, since it seems to be kind of like an inventory heavy business, like you're having to actually purchase, different things in order to then go out and sell, we were noticing that a big portion of the delta in cash comes from inventory and purchasing that inventory and making sure that you have sufficient lead time to purchase the inventory in which to later sell that. And so we thought it'd be interesting to maybe even show what it would look like if I had inventory financing and got some debt in to show what that might do to the business. But it's that type of analysis that you get whenever you do good bottoms up financial modeling and are able to understand all of the underlying levers that then bubble up into ultimately creating the financial statement. So that was just the direction that we would have taken.
Yeah, and Logan's 100% right on that when he talks about kind of what investors really are looking for. I think, just to be completely honest, I think Wedge Invest is kind of leading you in the wrong direction there in terms of what investors really want to see. I think investors ultimately, they do want to see these underlying mechanics, mostly because they want confidence that you understand the underlying mechanics. And if you show them, hey, here's how we acquire, here's how we monetize, here's our different product lines, here's how we think they're gonna open up, that just gives investors a lot of confidence that your business back in front, that you've de-risked the revenue ramp, and that you'll really be able to achieve the results that they see in the output of the model. So I think that's ultimately a big part of what we call the numerical narrative of a model, is kind of telling your story through the financial model. And that's the story of how you acquire customers, how you monetize, how you penetrate into the market and ultimately become a big business. So just a couple more 2 cents, I guess, on that.
I 100% agree. And I think, so first of all, I wanted to say, just for everybody, thank you all for getting up on stage and letting us kind of go through your all's financial models. I know that that's not easy. I know that you all put work into it. And I know that, it's easy for us to get up here and give all kinds of criticism, but it's a really, important step in an entrepreneur's journey is just putting together that first stab at a financial model. We mentioned that we will follow up with those links to Forecastr, which we just went through, so you guys can dive through that. And then we'll make sure that we get you one created as well as the report cards that we generated for all of these.
Yep.
For everybody on stage, we'll follow up with this specifically in an email, but we will give you guys 50% off in a Forecastr subscription and continue to build that model out all the way. So that you get like a really, really nice, clean financial model built that's been vetted by experts. And, to copy Ryan and pitching our own business and trying to monetize, I will say, everybody on here, you get 25% off. If you're not on the stage, you get 25% off. The 50% is just for the 3 that were brave enough to come up and work with us today. But that's going to include you being paired up with a financial analyst, an expert, much like Stephen and I are experts. This is going to be an expert that's going to help you build a financial model, coach you through it, make sure it's going to look good to investors, beat it up a little bit, kind of like what Stephen and I just did, but we're going to make sure that you're going to show well when you go out to raise your capital and whenever you are looking to make business decisions, that you're going to be in good shape. So I'm going to dig up a link to the beta application while we go through some questions, or if you want to add anything, but I will be sharing that momentarily in the chat. So be on the lookout for that.
Yeah, no, that sounds great.
Awesome. So we did have a 4th model, although the founder couldn't be here today. I do think based on the nature of the Q&A and that we've got about 12 minutes left, it might make more sense to jump into the Q&A rather than absent the person's pitch, we'll be just kind of grabbing at straws. And I think we have a good display of maturity of models. Dana, if you send over on some of the email threads, I know you said you actually have the Excel stuff. I don't think we can do it in real time, but we will get it taken care of, and I'll introduce you to the team and connect you there as well. So Logan and Stephen, you cool jumping into questions?
Yeah, I think that's the right approach, and we do have a model report for Whoosh or however you say that last company, so we can definitely send that, and that way you can still get the value.
The founder there is actually in a time zone that it's even later than what Femi's is. So I believe I thought he probably thought he was going to stay up till 11 or 12 and was like, no, it's the holidays, I can't do it. But we'll reach out to him.
And I just sent the beta application for anybody that's interested in learning more about Forecastr in the chat.
Awesome. Cool. So let's jump right in. Richard asked about halfway through, saying, should cash flow be parsed out into 3 separate things: financing, investing, operational, and then rolled up? Oh, yeah. Financing, investing, operational, and then rolled up. Sorry. Commas killing me.
Generally, yeah. I mean, that's the typical structure of a statement of cash flows. And like Stephen alluded to in one of his points of feedback is, not only is a financial model to give you as the founder understanding into your own business, it's also just a signal to the investor that you know what you're talking about, you know how the game is played, you know how things should be structured. So even if mathematically you can get it accurate without those 3 different sections, I think it makes sense to just go ahead and put them in those buckets, just because this is the language of finance that we're speaking, and the cash flow statement is parsed out using that language of those 3 separate buckets. So I think it is certainly important to have it broken out that way.
Awesome. Thank you. Adam Smith asks, and I'm sure the 3 of us can all riff on this, can you chat a little bit about the expectations of pre-seed, seed, and Series A? I would assume the robustness of the model and the history would be greater, but for pre-seed companies, there's just a lot more assumptions. So how deep do those assumptions go? That is the most articulated version of the pre-seed seed question I've heard. Thanks, Adam.
Yeah, totally. I'll say my 2 cents on this, because I love thinking about your financial model like you would think about your product. I think for everybody, when they think about a product, right, it's very easy to say, okay, well, I got this MVP product, this minimum viable product. I'm going to push that into the market. I'm going to get data. I'm going to improve that product to product market fit. I think from a financial modeling perspective, we think about the exact same process for a model, and we think about an MVP financial model. I think when you're at that early pre-seed, you really just need an MVP financial model. Now, it should have the core elements that we think make up a great financial model. It should have good representation of the revenue formula. It should have all 3 financial statements. It should be monthly out the next 3 to 5 years. It should be well designed, easy to consume. But in terms of like how many channels and how deep to go on revenue and all the math and the calculations, those can be rather high level and straightforward when you're just getting started, because if you go deep, it's just false precision. So, just have that kind of MVP financial model that represents the core assumptions around how your business is going to work, then push that business into the market. And as you get up towards that C, that Series A, as you get data back from the market, you're going to iterate and improve that model until you get model market fit, until your financial model, is well representative of how your actually business works in the market. So I think think about your model like you think about your product and evolve it over time.
I would add nothing to that. I think that's a really good answer.
Awesome. Good. Because we have a lot of good questions. So if we
There's one
riff
that
on
will-
it too much, it'll take us a while.
There's one that I will call out, which is a note from Michael Duke saying that he is looking for a fractional CFO. Michael, please get into contact with us. We can help you out. We have a fractional CFO arm. So I just wanted to call that out while it's top of mind.
Oh yeah, it's worthwhile to know that Forecastr is a SaaS company, but they also have kind of a services arm, and they scale with companies too. So it's way beyond pre-seed. Like they can significantly ramp up as well.
Yep.
Cool. All right. Doran asks, we have two separate models, 18 months, very detailed, similar to what you guys were showing off, and then a separate 5 years of like back of the envelope. Is that a good idea? And if not, why? Can you have both in Forecastr?
So the answer is, I don't think that that's a great idea. And the answer is you can. I wouldn't say you have both. They're kind of one and the same. They're rolled up into one and the same. The reason that I say it's not a good idea is that the way that we like to think about financial modeling is current state unit economics and future state unit economics, right? So if my cost to acquire a customer is X today, if I were to scale that out 5 years and hire 100 people and raise a bunch of money and really put a lot of weight behind that, over time, what does that look like, right? If I take today's state and I extrapolate that out, those same unit economics, what does that look like, right? It's really hard to do that whenever you're doing kind of back of the envelope and then mapping it back to how things are today and keeping those two things separate. And in addition to that, you may find that your current unit economics don't scale, right? You may find that the way that things work today, if I were to extrapolate that out 5 years, you're never going to be profitable, or your unit economics or your margins rather aren't going to look that great. So that tells you what to focus on today, right? And I'll give you a perfect example. Right now, we know that our logo churn rate is higher than we'd like it to be. If we also know that if we scaled it out as it's currently stands, where our customer, like what our churn is currently, we'd still have a really great business, but we know that our business could be a lot better if we were able to scale that down. So it just points at the metrics that are the most important to show which ones are going to have the highest downstream impact 5 years from now, 4 years from now, what have you.
Yeah, so we really preach a single source of truth when it comes to financial model. One financial model that rules the roost. It's a monthly model. It goes out the next 5 years. So that way you get the 2-for-1, right? You get that 18-month operational model like you have, and you have the full 60-month model that can be rolled up annually. And so you have that kind of high-level 5-year view all in one model. So when you make a change, you don't have to make it in both places. You don't have to worry about your current model disjointed from the model you're presenting to investors. You got one single source of truth.
Yeah. And so I'd say Forecastr, basically, you can look at it in those two ways. It's just a resolution of the model. It is not, having two at the same time.
Yeah, exactly. Kind of zoom in, zoom out is how we think about it.
Yeah. And I will double back on the doing things in year buckets hides ridiculous growth and assumptions. I know even if we did, our Google ad budget is like, we hit like a sweet spot of the 3x CAC per LTV, which if you tell that to any SaaS-based investor, it's like, you created a money printing machine, run with it. And if I drag that out in years, it'd be like, oh my God, we'll be billionaires. But the problem is there's a top level to Google ads where like not enough people are searching for terms around what our industry does. So even though the ratio stays the same, if I was to drag that out monthly and be like, well, we're just going to scale by shoveling $100 million into Google ads, it would clearly smack me in the face that was ridiculous. But it's a lot easier to look at that on a yearly basis and be like, oh, that number's big enough. Like, let's keep going.
Yeah, exactly. Well said.
All right. What CPM assumptions would you recommend for social media type startup? And can you tell me what CPM means?
Yeah, cost per mille. So cost per 1,000 impressions.
There we go.
And it's really hard to say. It kind of depends on what you're selling, what you're doing, what your space is. I think it depends on customer segment, the price point of your product, and that kind of stuff. So I will say, like, I probably don't have enough data to answer that question in an accurate way. but I'll give you one pointer on it, which I think is like when you're trying to figure out what should my assumptions be in a certain area for your business, I think one of the best ways you can get data on that is look at companies that are kind of in a tangential space to you, in an adjacent space that are maybe a little bit further along, and try to get connected to those founders. Try to have conversations with them about what they saw. Of course you can do Google searching and stuff like that, but I think if you just talk to other entrepreneurs kind of in your space that maybe are at the next stage up from you, you can sometimes get some good parameters around what some of your assumptions should be.
Awesome. Yep. I'm gonna start moving a little quicker just so that we can respect time. Alex asks, he's teeing us up to show off a Forecastr feature, but his startup Xander just finished due diligence with a pre-seed investor, and they spent a ton of time on what ifing against their model. And I know we have an entire presentation about this, so be on the lookout in the new year, Alex, for this. But really quickly, Logan or Steven, what are your thoughts on best practices of using your financial model with investors?
Yeah. It's a great question. We think it's an incredible fundraising tool, and it can really show, those what if scenarios really well. Whenever you say, for us, what happens if our churn rate doesn't budge, or what happens if we were to move upstream, or if we were to stay with our current customer segment and things like that. So what if analysis are great. We recommend at the minimum having like 3 different scenarios, like a base case scenario of what you think is realistic, a best case of like, if things go really, really great, and then maybe a worst case scenario for internal cash planning. But in general, we like to view what if scenarios as a way to showcase like the different levels of possibility for your business, and then just kind of like also show your understanding of the power of each of the individual inputs that you have, and show which inputs have the most impact. And I'll plug that Forecastr has scenario analysis built, into the forecast, so you can go in and make as many scenarios as you like. So.
And definitely having, if an investor asks you like, well, what if your churn, I don't believe these churn numbers, so what if your churn was 3 times as bad? And you can be like, tink, 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 well, this is what happens. And like, you can see exactly how the, well, maybe we'd have to fundraise earlier, or in doing these yourselves is great, and showing the investor that you're, not just answering these questions like, well, I'm confident that churn will not be high. It's like, all right, great. Great. Bryce asks, how do I build in one-time expenses versus monthly expecteds without affecting cost per unit? Like buying big chunks of stock for manufacturing or something like that.
Oh, yeah. I see. Well, so I guess it really depends. Like, it depends on if it's like a cost of goods sold type of thing, where like, if it's a cost of goods sold thing and you're buying a big chunk of units, then you're essentially going to be matching that cost for when the unit is sold. This is probably more of a technical answer than you're looking for, but basically that's going to be what's known as like is essentially a balance sheet transaction, where you're purchasing large amounts of inventory, but they don't actually hit the income statement, which means that they don't actually hit your margins if you're doing it for like an inventory purchase or something like that, in which case you allocate that expense on a per unit basis whenever that gets sold, so that your cost of goods sold is in line with what it needs to be. If it's not a cost of goods sold transaction, then it would either be something that you would expense on the income statement, in which case you would just have a one-time dip in margins. You just have to, talk about that to investors and your team, or you could do it on the balance sheet, which would take it off of the income statement, in which case it wouldn't affect your margins. And that way you would just include it as an asset to be capitalized. Again, that may be more of a technical answer than you were looking for, but
well, I think this highlights why you want the multiple views. You don't want to just have a forecast or a P&L, because you could end up in a liquidity crisis where your business is solvent, but you have to pay $500,000 for the next chunk of material that you need, and you don't have the cash to do that. So that's a great lens. And that's why the balance sheet plus the P&L plus the forecast all kind of like support each other.
Exactly.
Solvency and liquidity crises are all the rage these days in certain industries.
Yeah.
Let's see. We got Waylid asks, creating a model by month. I think we've already covered this. Yeah, it's very easy to show it by quarter or year. If you start with month, that's basically the underlying mechanics, and then you can look at it from many different perspectives. From the founder point of view, does Forecastr allow comparison between versions of the model, and as well as actuals? Yeah.
So we do integrate with QuickBooks and Xero, so we can put in your actuals. We can like have that automatically pull to the forecast. So that's one of the biggest value propositions of Forecastr, is that it's a model that's always up to date. It's a living, breathing document. You're not having to go in and update it all the time. And in terms of scenario comparisons, we're building an entire feature suite around just like literally comparing like revenue deltas, like per scenario that you have. We do have the ability to have as many scenarios as one, clone scenarios and do full sub with them, but we don't have one section that just like literally compares and contrasts different scenarios. So yes and no, I guess.
But it's on the roadmap. Yeah, the
It's
scenarios
on
are
the-
definitely
of
in there.
course,
Yeah.
of course, yes.
Logan, do you have a little bit of time with us to get through the rest
Yeah,
of the
I've
team?
got time. We lost Steven obviously, but yes, I have some time.
Awesome. Well, thank you very much. So Anthony asked a nice feature question. How long does it take to get a forecaster model kind of up and running and be presentable?
Yep, great question. So we give you 30 days white glove onboarding. You can get it done sooner than that if you wanted to lean in and like really help get everything set up. But 30 days is kind of what we recommend. Our analysts meet with you. Typically, we do meet with you once a week, and then we structure the onboarding kind of like depending on the client's needs and what have you. We can kind of tailor it from there. But that's my canned answer is about 30 days.
Cool. Bryce asks two interesting questions. One, kind of general, can you give what are key metrics to stress test your model? And then additionally, what are the key metrics? Can you get a valuation, like a company valuation out of your model?
Yep. So great question. Depends on, I'm trying to figure out how long I want to spend answering the second part of that question, but I'll start with maybe the first part. So what key inputs do you need to focus on? I would say anything that is designated an input, so something that's a controllable metric that drives formulas on your biggest revenue streams, right? So whatever, if you look at your financial model and you're looking at what revenue number is coming from like the biggest source of revenue, looking at the inputs there and then figuring out what has the highest impact, those are the ones that you really need to focus on and make sure that you get right or get a lot of data around. That's one of the things that's great about Forecaster is that the analyst is going to help you understand what those inputs are and which ones you actually need to focus on. So for us, I can tell you, and if we have more time, I'd show you our financial model. I know that our price has a significantly higher impact on our business than our churn rate because we do annual subscriptions. So if I need to spend time focusing on anything, obviously you want churn rate to go down, but spend more time focusing on price. In terms of the valuation, so if we're talking about there's kind of two different paths I can go here. One is like a standard 409A valuation. So that's kind of like a legal valuation for stock strike prices. That's not something that we do out of the box for Forecaster, although forecasts do tend to power 409A valuation. So like, I guess tangentially, we can help you with that, or like we can aid in that process. If we're talking about fundraising valuations, I would say that the financial model should not be something that's used to lean on or, try to argue a value for a company. It's kind of a first-time founder mistake a lot of people make is they try to have a financial model that has these lofty projections. They back into a valuation using some big long formula like a DCF, discounted cash flow model or something like that.
It's just 10x revenues, Logan. You just take your revenue, multiply it by 10, and then you go raise money.
Yeah, 10x it and then back it back. That doesn't fly with investors. The financial model, don't get me wrong, is an amazing fundraising tool. It should absolutely be leveraged in the fundraising process, but it should be used as a communication tool. It should be used as a communication tool to communicate your vision, to communicate the scalability of the business, the unit economics of the business, all of that stuff. It shouldn't be used as something to back into a valuation that you're going to defend to VCs. Why is that? Well, there's a bunch of reasons, but the biggest one is that it's all conjecture, it's all guesses, you can poke holes in it. The one thing that we know about any forecast is that it's wrong, and investors know that, and you know that. So it's not something that you want to lean too hard on, but it is very, very powerful and just showing your understanding of the business and showing what targets you need to go out and execute and hit on.
Yeah, I'd say the relationship is actually switched. When you're fundraising, you're convincing an investor of an opportunity and they know it's risky. So you're mostly convincing them in your narrative of a market size, a team composition, traction so far, and then the model backs up the story that you're telling, de-risking it, not guaranteeing it by any measure. If your model is like, drag it to $10 billion, like, of course we're going to win. There's no way we're going to lose. Investors will be like, oh, there's plenty of ways you can lose. What I'm actually looking for is sell me on the story of narrative of your company and continually back it up with things like, hey, traction so far, proven by our financial model. This is where we think it could go, but like, who knows? Cool. Susan asks, this is a fun one in between you and I, Logan. I've included my cap table on my financial model. Is that the norm?
Yeah, great question. I would say it's not the norm. It is useful, I guess, to an extent. Like, I mean, you could do some interesting stuff with that where you can project based off pro rata ownership what people might end up taking home at the end of your 5-year projections. But it's not necessarily the norm. They're usually two separate documents. And Ryan, I would say, knows significantly more about cap tables than me. So I don't know if you want to chime in with your thoughts.
I think it's not surprising to think of like opening up a tab on a spreadsheet and being like, oh, and there's the ownership, especially if it's simple and it's early days. Often you're giving up the financial model and the cap table at a similar time in a fundraising process when companies are doing diligence on you, or well, investors are doing diligence on you. So they usually come together, but you don't necessarily have to bake them in together. And more selling Gust stuff, it's much better to use a cap table management software than a spreadsheet. So the sooner you can get your cap table into something that actually models equity in ways that limits mistakes, shows preference stacks, shows round modeling, and shows all that good stuff, just like Forecastr, your cap table is going to look better. We have a cap table modeling solution. If you're not incorporated yet, Gust Launch includes all of it, cap table, all the documents, all the templates. We file your thing in Delaware. If you're already incorporated and ready to go, just go to equity.gust.com. We have a free cap table tool that will hopefully prevent you from making mistakes, because spreadsheet cells can get inaccurate. And when it's talking about ownership and upside, like those inaccuracies can be very damaging in the future and not give you a full list of that. So no issue starting out, but I would recommend using a specialist tool for that.
Yep.
Benjamin asks, can the Forecastr program take revenue projections of a startup and adjust them to the projected quarterly changes in GDP? Interesting. Takes the micro of the company and adjusts it to the macro of the economy.
Yeah, I would say yes is the answer, because we can do any kind of like customization that we need. So if that's something that you'd like to include, then our analysts can certainly build that out for you. I would say that I probably wouldn't waste my time with that for like a couple of reasons. It's like, one is that, as startup founders, it's really tough to get into the business of being like, economists ourselves and trying to project the next several quarters GDP changes. It's just, maybe they're right, maybe they're wrong. But at the end of the day, when you're in the turbulence of an early stage startup that is going to live and die on its ability to just essentially start generating revenue and get on that growth curve, I don't know how much you're even really, maybe you'll notice it a lot depending on your industry, the fluctuations in GDP, but anything outside of a major recession, I would say it's probably not worth including in your financial model. Now there's kind of like a analogy that I like to give whenever it comes to this, because we get asked this a lot as an early stage startup, is like, well, how are the macroeconomic trends affecting you all? And I like to say, it's like, well, it's kind of like asking us how the turbulence is while taking off while you're 15 feet from the runway. It's like, well, maybe there's some turbulence, but I can't really tell because I'm like literally doing this right now. So it's like, if it's affecting it, it's so minor in the grand scheme of all the other major things that are impacting my business that it's kind of hard to answer. So that's kind of my answer on it.
Yeah, I think a nice thing about having a model though is you can anticipate scenarios. So big scary news comes out, right? Russia invades Ukraine. You have a financial model. If your CEO or your COO or your salesperson says, hey, what if this chaos causes people to take less risks? Like Gust, we do companies as a service. We make money from startups, a healthy startup ecosystem. So if we have a financial model, we'd say, hey, what if everybody just starts to like husband their cash and be less risk averse or whatnot? We can at least simulate it, rather than just ask the question and be like nervous about it, being like, it'd really suck if people stop doing that. Instead, you'd be like, well, what if, for 2022, 50% of, the acquisition just tanked because people were just kind of holding on, seeing what was going to happen, jobs became more thing. You at least get an idea of like, and you can anticipate like, hey, maybe we need to make changes. Maybe we don't sign into a massive annual contract with a vendor to like save 10% because that'll be cash outflows and like yada, yada, yada. So again, I wouldn't plug GDP into it and be like live updates, but in the stock market and stress the hell out of yourself every time you look at the financial model, but you can use it to simulate stuff.
Daytime. Yeah, good point, Dave.
All right, I think we got everything. Nafis is actually answering a question for Susan. Throw that in the chat if you can, Nafis, because I don't think they can see the Q&A. Last question, softball. Rich asks, what is the pricing structure of Forecastr?
Oh, great question. Okay, so we have a tier-based pricing structure that will scale based off of expenses. So why do we do that? We want to give you full-on value of Forecastr. We don't want to limit your value that you get. We want to give you all the integrations, all the scenarios, all the users, everything that we can. And then we want to grow with you so that as you're successful, you're able to raise money, you're able to spend more money. Then we'll take a little bit of that, but we'll never be expensive based off when compared to your overall expense base. So to directly answer, if you're less than $100,000 of monthly expenses, we're only $2,000 a year. Now, the three folks that are on with me right now, they get 50% off that. So they're only going to be $1,000 a year. Everybody else that's on here gets a 25% discount off that. So it's only going to be $1,500 for that first year if you're less than $100,000 a monthly expenses. And I would say that most of us probably are at this point. As you scale, then that price is going to scale with you. So if you're between, I think it's 200,000 to 300,000, I think it scales to $5,000 a year. And then up, all the way up to, if you have like $1 million of monthly expenses, then it goes up to like $15,000 a year. So we try to scale with you. So we try to never be overly burdensome from a, expense standpoint. So we're always hoping to be affordable. And our goal is to get you successful, get you funded, all of that stuff, so that we can share in some of that success. It's a great question. I think you're muted, Ryan.
Yeah, that sounds great.
Too many mute buttons. Thank you very much, Logan. We got through all the Q&A. Thank you for giving us 15 extra minutes to get through that. I'm so excited. There were so many questions and they were very relevant. This was huge. I think this is the highest attended event we've ever done. So maybe we should take something away from that. Amy, Dana, Femi, we couldn't have done it without you. Thank you so much for showing up, hanging out with us a little bit longer, and sharing your financial models. And hopefully the feedback was useful. Dana, I'll connect you with the Forecastr team directly so that you guys can get the follow on from that. The links are in the chat. We will send a follow-up email probably mid next week with tons of links and information and things like that. And I think we're good. Logan, any parting words?
I don't think so, other than thank you all so much. And I think, like you said, Ryan, like this is a really successful event. So I look forward to maybe making this a regular thing. But it was a lot of fun. I thought it was great. So thanks everybody for joining.
Thanks a lot, everybody. And I will send a follow-up. This kind of concludes our prepare series. This is kind of like a bonus footage. But I did throw a link in there. I'll throw it again. We have collected all the recordings that we've done. We did another one with Forecastr, which is Financial Modeling 101. It's on that page, the recording of it, as well as that discount link. It's still there. That's really great. If any of these concepts came up and you're like, I don't really know about the inputs, or, I don't even know where to get started. We go right through it from the beginning stages. And there's a bunch of other compatible programming and complementary program we've done over the last 6 weeks or so that will hopefully be useful if you're in the early stages of the thing. Be on the lookout for new stuff from us in the new year. Gust and Forecastr, we're going to do a whole other event series about kind of 0 to 1 launching, and tons of other fun program in between. Have a wonderful holiday season, everybody. Thank you so much for showing up at December 22nd to our virtual events. Dana, I really like your decorations. I'm a decorating enthusiast.
Thank you.
Have a wonderful holiday and weekend, everybody. We will see you in the new year.
Thank you, everyone.
Thanks,
Thank you,
everyone.
Ryan.
Bye.